Welcome to Stocks in Translation. I am your host, joined as always by the voice of the people, Sydney Freed. Before we get started, please like, subscribe, and comment on Stocks in Translation on Spotify, Amazon, Apple Music, YouTube, etc. And today we are welcoming Christina Hooper, who is the Chief Global Market Strategist at Invesco. Hello. And today we're going to be talking about the markets post-election, but also looking ahead to 2025. Our phrase of the day is the business cycle. We break down the highs, the lows, and everything in between. This episode is brought to you by the number 48.4%. That's how much commodities typically rally after the Fed starts cutting rates. We map the 2025 possibilities. And before we dig in here, Christina, thank you for joining us. Give us your overview of the markets so far, let's just say since the election.
So we've had a mostly positive reaction to the election, and we've seen stocks move higher, cryptos move even higher on expectations of deregulation there. So I think that we've generally had a very positive risk-on environment, but there have been hiccups in a few spots, and in particular around the 10-year yield and long yields going up because of concerns about the potential for fiscal deficits getting bigger. And so I think that's going to be a topic that continues well into 2025 and beyond as we face the prospect of perhaps even larger fiscal deficit.
Yeah, and I think that's a good time to segue into our phrase of the day, which is business cycle, and it ties into all these interest rates that we're talking about. So here's the definition of the business cycle. It's the economy's recurring pattern of growth and decline, which occurs in phases. So we have the expansion or growth phase, we have the peak, which is the highest point, the contraction, which is the decline, and then you have the trough, which is the lowest point. It's pretty simple, but sometimes we don't even know exactly which phase we're in. And just tell us, how do you see the business cycle, and how does it help you frame your discussions?
Well, I think it's important to recognize that we tend to have stocks act in certain ways in anticipation of different parts of the business cycle and in being in parts of the business cycle. So, for example, I think right now what we're seeing is stocks anticipating an economic reacceleration next year. And so I think we're going to see small caps and mid caps perform better, cyclicals perform better because they're more sensitive to the economic cycle. I think we're also likely to see some international equities perform better as well. I think in general, globally speaking, the economy is going to reaccelerate. So I think there's a lot of connection between the business cycle and the performance of different assets, especially stocks, although it's not entirely predictive. Being in a particular economic cycle, phase of the economic cycle, does not predict exactly how things go. Exactly.
So there are some people who are talking about going into year 3 of a bull market that we might not see as crazy returns as the prior 2 years. How does that do you agree, or does that factor into where you see growth going? How are you thinking about that?
So we've had a strong 2 years, let's face it. But I think there's more powder, more dry powder there. And that's really because we have central banks behind markets. So this is kind of unusual in that central banks are easing into growth. We tend not to see that. We tend to see central bank easing occur when economies are in much worse shape, typically in contraction, going into contraction. This is a different environment. And so I think there's certainly a fair amount of dry powder. If we go back to the mid-90s, that was the last time we saw the Fed actually hike rates, have a tightening cycle without causing a recession.
95, 98.
Right, exactly. And so the tightening cycle was 94 to 95, and then the easing cycle was 95 to 96. But and so we saw some really good stock performance in the 6 months, 12 months out after that. But that easing cycle was very limited. It was only 3 rate cuts, only 75 basis points. So if you think we're looking out on another 100, even just 100 basis points in rate cuts on top of the 75 we already got, that suggests a lot more fuel powering risk assets going forward, especially as we see a relatively good economic environment helped by real wage growth. So inflation-adjusted wage growth, disinflation continues, so there's more spending power for consumers. I think there's a lot going for this economy, especially the global economy, but especially the U.S. economy, given how resilient it's been so far.
And talk to us about soft, hard, no landing and how that figures
Guess
into the
people are getting
business
mad at
cycle.
us when we say landing now. I got to.
Yeah.
So where does this fit into the business cycle?
So I think what we're seeing is a very soft landing. So we're not going to see a recession in the United States, and arguably it's not much of a landing at all, right? It's a slowdown and then a reacceleration, and we can have that in business cycles. They're not perfect. There can be mid-cycle slowdowns. There can be
Mid-cycle expansion is what we're hearing.
exactly,
Yeah.
and so that's what we're seeing, and that's what I anticipate we'll continue to see in 2025. Is that a very, very modest slowdown followed by a pretty significant reacceleration. And that is the kind of environment that I think is quite good for all kinds of risk assets, but especially stocks. And you also have the animal spirits created by the potential for deregulation. So there's a lot going for it. Now, there are also some concerns, right?
Let's talk about rates and the higher dollar as a perfect example of some concerns. Historically, higher rates and the higher dollar sometimes derail or at least are concurrent with equities rolling over. So any concerns here for you? Because we've seen them both elevated and moving higher pretty quickly recently.
So much of the dollar's movement has to do with expectations around monetary policy. And we've just seen such a resilient U.S. economy that expectations have changed in the last 2 months about how much the Fed is actually going to ease. But I think we're going to get significant easing. That doesn't mean, though, that the U.S. dollar weakens a lot. I think it weakens more relative to some currencies than others. I think the euro weakens a lot more because the expectation is with weaker data that we're going to see more ECB easing than we're going to see Fed easing. That's okay.
It's relative.
Exactly. It's relative. And I think the bigger picture is that the Fed is easing. I think
So no dollar wrecking ball just yet. Watch
I
it.
don't think so.
Okay.
I don't think so. I mean, I think what we should worry more about is the potential for short-term sell-offs because of the application of tariffs.
Mm-hmm.
They could be long-term tariffs if long-term sell-offs if the tariffs are kept on for a long time. But to me, I'm not too worried about the dollar thus far. I think we're going to get enough easing in the next year that we're not going to see the dollar go up a lot.
Tell me in layman's terms again, what is the situation with the dollar? Why would the dollar tend to rise when the Fed starts to cut rates?
Well, it's expectations around other central bank activity. So, and a few other, a few other factors impact the dollar, including growth expectations. And so the economy's been in good shape. So if it strengthens and you have the Fed not cutting very much, that can send the dollar higher. But
you said you expect the ECB to cut more, so maybe that explains
yeah,
some
absolutely.
of the flight into the dollar.
But I think the dollar will be somewhat on par with the pound. I don't think the Bank of England is going to be very different than the Fed in terms of its policy path going forward. So it's going to be a situation where the U.S. dollar is not going to have the same relationship with every other major currency. And quite frankly, if we see Bank of Japan hike further, I know it will be in a measured way, but if they hike further and the Fed is easing, that relationship improves.
Mm-hmm. How concerned should investors be about the deficit and rising yields? In your notes to us, you mentioned former UK Prime Minister Liz Truss.
Who you just mentioned.
I feel, and I know, I also feel like we talk about Liz Truss all the time, and I'm like,
Do we?
What?
Do we really?
So
It's a good
yeah.
story, though.
Tell me a little bit
is.
about this.
Well, first of all, I mean, I think it's wonderful that she was PM for such a short amount of time, and yet her name lives on. Maybe not in the
one way
most
of looking at it.
positive way, but boy, she's part of history, so that's great. So I think the concern is that we get to the point where the bond investors, the U.S. Treasury buyers, thin out. Because there is a lack of tolerance for the kind of imprudence we've seen fiscally. Since 1960, every year, with the exception of like a little over 2 years, we've seen a budget deficit by the U.S. Now, Keynes believed in budget deficits, but deficit spending was only supposed to occur during crises. we haven't had a crisis every year. Yes, in the last few years, we have had a pretty significant crisis in the pandemic, but we were doing deficit spending long before that. And so this year, actually, we got to the point where the combination of the high level of overall debt we have, plus the hike in rates caused by the Fed, meant that our line item in our federal budget for servicing our total debt was higher than our entire defense budget. That's just not sustainable, in my opinion, for the longer run. And so something has to happen. Now, luckily, there are those two levers. So as the Fed cuts rates, we're likely going to spend less to service our debt. But there also needs to be more effort to control spending. And I think the fear is without the checks and balances, whenever you have an executive branch that has the same political party as the legislative branch, you worry that there aren't as many checks on spending. So I think that's part of why we've seen yields go up recently, is that concern. And of course, we have to worry that bond vigilantes might be around the corner.
All right. You said the word of the day, and there is a word of the day besides the phrase of the day, vigilantes. So we're going to have a little funfetti drop down. New thing we're going to do going forward, Sid, that you didn't even know about.
Oh, I'm excited for funfetti.
All right. So we need to take a short break, leave everything here for a second. But coming up, we're going to talk about what is in store for 2025 for investors, as well as a Who Wore It Better, where the bond vigilantes make their fashion debut. Stay tuned. This episode brought to you by the number 48.4%. That's how much commodities like gold and oil typically rally after the Fed starts cutting rates. But critically, if we do not get a recession. If we do get a recession, futures returns average a negative 8%. And that's in contrast to that almost 50% in no recessions. And so we see a similar thing with stocks. They tend to be up 19% with no recession, but when there is a recession, they go negative 4%. So what do you make of these things? And this is kind of how we're game playing 2025, because the Fed is now cutting rates. Which path, the no recession path is what seems to be playing out, but why the difference?
Well, I think a lot of it has to do with also timing. When the Fed cuts and then the economy goes into recession, that tends to be the worst case scenario.
Because it's unexpected.
Exactly. It's unexpected, and you're already essentially making efforts to improve the economy, but it goes in the other direction. Of course, the best case scenario is one in which you're throwing stimulus at an economy that's always in good shape, that's already in good shape, and it can move higher. And I think that is where we are today. It's an unusual scenario that I think we're lucky to be in. The economy is in quite good shape, although there are real pockets of weakness. And I'm not trying to be Pollyanna-ish about this. We certainly have lower income Americans that are under very significant pressure because of the accumulation of price increases over the last few years. We have areas like manufacturing that has definitely taken it on the chin. We look at PMIs, still in contraction territory. But overall, this is quite resilient economy, one in which household net worth on average is much higher than it has been. And so that is an environment where if you throw some stimulus at it, whether it's monetary or fiscal, it can result in not just an economic reacceleration, but I think strong returns from areas like stocks and commodities.
So the economy's chugging along. We're not seeing a recession. However, I want to ask, what are early indicators that point to a future recession?
Well, there are a whole variety of indicators. We want to look at delinquencies and how much they go up. But if we look at delinquencies today, they're just a bit higher than where they have been. We're really at pre-pandemic levels, so nothing to be concerned about. And I think the single largest indicator, of course, is labor. How much the unemployment rate goes up. Of course, we have the SOM indicator. There's lots of different measures.
And
that
potentially a new immigration policy.
Absolutely. Now, that could, from my perspective, I think the biggest issue that we could see with a very different immigration policy, let's say we actually have 15 to 20 million deported. That could be very problematic for an already tight labor market, especially one in which there's tightness in certain industries that could drive up prices. Agriculture, for example. agriculture workers. If you had to pay a very large amount of money for workers because you lost a large pool of them, that could drive up the prices of bananas, grapes, all kinds of things. So, just to give one example, that of course could then trigger, if you have higher inflation, that could then trigger the Fed actually putting the brakes on easing and even hiking, although I think that's very unlikely.
What do you see when you're close to a recession? Does the stock market start to like teeter down, or does the stock market start to teeter down and then you see a recession? Which came first?
I think it's if the Fed is really scared, then you see the big drops. And the Fed is scared when they're dropping the rates by 100 basis points at a time. And so they're cutting by a lot, but we know that it's going to get worse, so stocks go down. That's my answer.
I want to refocus on the stock market. So everyone's really excited about things like potentially small caps breaking out, regional banks, energy stocks. What happened to the Magnificent Seven in all this? Are we still excited about it?
Absolutely. We just have to recognize what the Magnificent Seven offers in terms of advantages and disadvantages. So the Magnificent Seven has delivered very significant earnings growth over time. But it's also priced close to, if not at, perfection. So one has to recognize that you can get a very strong earnings report and investors may be underwhelmed. They may actually punish the stock,
Like
even
NVIDIA
though
went down last
exactly,
week. Yep.
even though it essentially met expectations, because it's priced close to or at perfection. And so I think Mag 7 is definitely part of the stock market, part of what we're likely to see in terms of a rally, but is unlikely to be at the lead because you've got small and mid-cap stocks, you've got cyclicals with much lower valuations, and you have this strong catalyst driving them, which is an economic reacceleration. Tech names are secular growth names for the most part. They're not tied to the business cycle, so they tend to be rewarded as defensives. But when you have an economy that is reaccelerating, where you're likely to see the bigger gains, the bigger rallies, is going to be in those names that are more sensitive to the economic cycle.
I'm hearing the Mag 7 being called the Lag 7, but we don't have to do that here.
Sad.
I want to ask you for 2025, what's your number one thing you're looking out for, the thing that maybe is on investors' horizons, maybe not, the number one thing you're looking for in 2025?
Well, I'm not looking for it, but I want to be on alert, and that is a resurgence in inflation. It's certainly not my base case, but we want to follow it closely. I mean, let's face it. We have a U.S. economy that's been quite resilient, areas of real strength within the U.S. economy, and we're providing monetary stimulus. Also, if we have, for example, tariffs applied, and they last a while. I mean, I think if they're very temporary, it's not going to impact inflation, but if they last a while, and if you have a radical immigration policy, all those things can fan the flames of inflation. And of course, that could alter the course of monetary policy and could then, of course, alter the course of stocks, could alter an economic reacceleration, all those things. So that would be, to me, the most important risk to be looking for.
All right. Sticking with the 2025 outlook theme, we've got a showdown on the runway this week with who wore it better, of course. Up first, we have artificial intelligence, the shiny new upstart, hyped to automate the mundane and perhaps the profound. AI promises to redefine productivity and disrupt entire industries. In fact, AI may have written some of these very words. Some of them. Then we've got the OG troublemakers in the yard. It would be the bond vigilantes. These market mavericks don't play nice. They see your deficits, your wild spending, and they've got their sights set on cheaper bonds and higher yields. Think Clint Eastwood staring at a T-bill. Then we got fiscal. We got fiscal things to think about. We got governments quaking in their boots when these bond vigilantes assert themselves. What are we to make of this? And I guess the question is, what is the driving force of 2025 going to be? Is it the AI theme or is it going to be the bond vigilantes?
I'm going to argue neither.
Okay.
But both are certainly important themes. AI is going to continue to be a theme. What we got from the third quarter earnings reports was that it's more important than ever. It's getting utilized more than ever. It's helping many companies improve sales. we're finding more and more ways in which it is improving productivity. Hearing about the kinds of millions of hours of coding time saved because of AI co-pilots in coding. So there's so much there, and I think that theme continues. But it may not have the kind of prominence that perhaps fears around bond vigilantism might have going forward. I think that's probably going to get more attention. Although, in reading, recent data, we are seeing that foreign investors continue to pile into treasuries. The most recent data is as of the end of September, but we saw a number of countries actually add to their exposure. So even as Japan and China and our traditional largest buyers of treasuries have cut back a little bit, others have filled that void, so to speak. And so I'm not sure we're anywhere near the tipping point with bond vigilantism, but it's important to have that discussion because we really do have to get our fiscal deficit in better order.
What are your investment strategies around AI and the bond market? Two different things right now.
So, investment strategies around AI, I mean, I think first of all is the recognition that it impacts so much. So, it is not just about a few mega cap tech stocks. It is about how other businesses are using AI to be more productive, to be more efficient. And I think what we're going to find is that as it becomes more ubiquitous, it's the small businesses that benefit the most, that are able to really leverage it in ways that are very impactful to the bottom line. I also think we have to think broadly that the REIT space, for example, is a beneficiary. When we think about data storage facilities, we have to recognize utilities and energy are beneficiaries of this AI revolution as we use more energy to power AI. And so there's just a whole world of opportunity when it comes to AI. Some more shorter term in nature, but a lot of it far longer term in nature.
You think we get a repeat of the late 90s where we had double-digit returns for like 3, 4, maybe even longer years in a row? Is that possible?
I certainly think there's the potential there. In many ways, we have we see a lot of parallels to the 90s, right? The same kind of Fed behavior, in that this could be the next time the Fed was able to avoid recession, right? And then set off a multi-year rally. And we're also seeing, back in the 90s, we saw increased spending on technology for the internet, for Y2K, help improve technological infrastructure in general. Absolutely. And then it boosted productivity. I think we're seeing a parallel to that this time. Because even companies, when they're asked, do you think you're overspending on AI? They say the risk of underspending is much greater than the risk of overspending. And we're also getting all these ancillary benefits. We've improved our technological infrastructure for the future. So not dissimilar to the 90s in many ways. So I think we very well could see similar conditions when it comes to returns.
Christina, less than a minute here. We want to ask you about someone you admire or respect in the community. Tell us about that.
Well, one strategist that I think hasn't necessarily gotten a lot of attention recently because he passed away is Byron Wien. But he was really one of the people who created the role of strategist back in the 1960s, and I think was incredibly impressive and had such an impact on the industry. He was famous for creating his list of top 10 surprises, which was incredibly well-read, very much anticipated each year. He also put together 20 life lessons that I find very valuable, and I keep hung up on my wall. So I think he was, to me, a great inspiration.
All right. We're going to have to leave it there. Byron Wien, RIP. And thank you, Christina, for coming down today. Be sure that you check out our other episodes on the Yahoo Finance site and mobile app. Also, your favorite podcast platforms, YouTube, Apple, Spotify, iHeart, Podtail, Podterra, Paradise, and more. That's all for now. Keep it tuned at Yahoo Finance.